This chapter covers auditing for cash and financial investments. So the objectives for a cash audit is to understand the client and consider the inherent risks relating to cash. So obviously, those will be high. Everybody, if you're going to steal something in a business or misappropriate assets, cash is going to be the number one that you're going to want to try to steal. So the auditors want to definitely make sure they understand what internal controls are in place over cash, and then make sure that everything is properly tested so they can understand if there's any material misstatements of cash. So then this list at the bottom of the PowerPoint, these are the management objectives that they are trying to test over the audit. So then you do want to understand what each one of these relates to cash. So we want to verify the existence of the cash so that, like, if they have it on their balance sheet, that we're going to trace it back to bank statements or confirm it with the banks to verify that just because it's on their balance sheet, yes, it truly exists. Then we want to establish the completeness of recorded cash so that we're not missing any cash transactions that possibly money came in and didn't get recorded. The cutoff and the accuracy is saying that we want to make sure that, like, everything that was paid as of December 31st is showing out of our cash accounts, and there's no like timing differences in the cash account. Determine that the client has the rights to the cash. So you figure if it's on their balance sheet, is it maybe designated for specific purposes that they need to make note of? So is it really their cash to use as they see fit? And that everything is disclosed properly in the notes to the financial statements. So here's some general guidelines when we're talking about cash. So we don't want to permit any one employee to handle the cash as well as like record the transaction. So you should have a separate person who's involved. So like say your Lowe's, you've got your cashier who works the register and handles the cash. Well, then you're going to have somebody else in the back offices or like at a cashier's office that's going to actually do the record keeping to say, okay, this is how much cash came in, and record that and record it as a deposit into the bank, so that the person who's handling the cash couldn't then steal some and then just only record the difference. Centralize the receiving of the cash. So many times what companies do, big companies will have a lockbox set up at a bank. So the money goes directly into that lockbox, that bank, so that really nobody even at their company is actually touching the cash or the checks. It's all going right into the bank and getting deposited. Or again, that could be wire transferred in right into the bank, and again, nobody's handling it. If you are handling the cash, though, or having that cash receipts come in, make sure that everything's being recorded on a very timely basis. Should be every day as the cash is received. And then encourage customers to take their receipts, because again, your customers can act as a double check that the cashier has charged them correctly, that all the sales are being handled properly, and it doesn't matter dollar amount wise. If it's a cash transaction, they should be given a cash receipt. And then some additional deposit the cash receipts promptly. So like I said, that's why many companies will have lockbox deposits and or have wire transfers. So then there is no person who's handling those. Make all disbursements by either checks or wire transfers or electronic funds transfers, with the exception only of like a petty cash box. So a company may keep like $200 in a petty cash box where they could pay for postage stamps, or if the maintenance guy needs some WD-40 or something and you don't want to give them a credit card, just things like that. But all other payments should be made by check, so there's a nice paper trail. Reconcile the bank statements every month. And normally that should be done by somebody higher, like maybe even a controller or a CFO. They at least should look over that bank reconciliation. And then monitor all cash receipts and disbursements, again, at like a management level. If it's very large, again, you could use data analytics software to see if anything jumps out at you, to see if there's any major differences. So the auditors need to assess the risk of that cash. So the first thing that they do to assess the risk is to understand the client and the environments. Because again, like say they're auditing Firestone Tire. Well, they might not handle a lot of cash. Most of their payments are probably going to come in check or electronic transfer, things like that. But say you're Lowe's or Home Depot, you have a lot of cash and registers all across the world. So that could be, again, a higher level of risk. But then once you determine that, then understand, well, what's your internal control structure? How are you protecting that asset so that people are not stealing it? And then you're going to consider both of those things to assess the risk. And if you assess the risk at high, that's going to increase your testing of the cash. So then some additional tests of controls. Again, these are the controls that are in place to ensure that the cash is not being misappropriated. So you're going to want to verify that the accounting records are accurate, that the bank reconciliations are done and signed off by somebody who has a little bit of management level. Look over the accuracy and the completeness of both cash receipts processing as well as cash disbursements, and then trace those into the accounting records to see that everything seems to be posting properly. Then substantive procedures for the cash transaction. So this was our test of controls, kind of making sure everything's running smoothly. Now our substantive procedures, we're actually going to try to tie out the balances that are on our financial statements. So we're going to look at those cash balances, reconcile them back into the general ledger, reconcile them back into or confirm those with the financial institutions, look at the bank statements, prepare the bank reconciliations, and then make sure that, so say if you're looking at their bank reconciliation and they have checks outstanding, you could then go to the next bank statement to see, okay, those checks in those amounts did clear the bank, so they must have legitimately existed at the end of the year if you can then see them come out. And then this is a nice little summary of these, again, to understand these primary audit objectives: the existence and accuracy, existence, occurrence, accuracy, cutoff, and rights. That's kind of almost all of them. Then down this one has the completion or the completeness, and then our presentation and disclosure. So these are the different types of procedures they could do. So again, reconciling the actual cash balances into the general ledger to support the balance on our balance sheet, confirm those cash balances with the financial institutions, obtain reconciliations of that bank balances, then do that cutoff statement to show that if it has deposits in transit or checks outstanding, you can trace those through to the next statement, count any cash on hand, verify their cutoff transactions, analyze any bank transfers, again, occurring right around year end, and then look at the payments to the related parties. And the auditors always evaluate the financial statement presentation. That's part of their audit procedures. Now, kiting is something that is like a fraudulent act that can happen in cash. So the auditors have to be aware that this scheme exists, and they want to be able to see if they can detect it. So what they would do to detect it is to prepare a schedule of bank transfers for a few days before and a few days after that balance sheet date. And then they're going to want to look at is there a date of recording that transaction on the books any different than in the financial statements. So like the date of the check that was recorded by the bank is from a financial statement period prior to the books. So again, kind of look at that date, because you can, in a sense, kind of just float that cash so that it would cover any missing cash. And it's just a timing thing, but the auditors can kind of analyze that to see if they see any differences. but like it says down here that anymore our check clearing can happen so quickly. Like back, 10 years ago, there might be a 2 to 3 day lag on depositing a check and when it actually comes out of your account. Now everything's so instantaneous, it's a little harder to do that. Then our financial investments, those again are a little bit different than our cash, because this is going to be if we've invested in like stocks and bonds of other companies or in the money market, just like financial type of investments. So we have the same objectives though to substantiate that they actually exist and that they occurred in the proper period, that they are complete in what we've recorded on our financial statements is really all that we have. We want to look again at the cutoff to make sure there's no timing discrepancies and that all of those are actually the client's investments, that they have the rights to those. So the valuation, now that gets a little bit more advanced when we're talking about financial investments. So it depends on what type of investment it is, because we could value it at cost. We could bring it up to its fair value or its market value and have it like an unrealized gain or loss. Or it could be the equity method where we are owning more than 30% of that company and we kind of control them a little bit, in which case we use the equity method of accounting, which is different. So again, we'd have to understand what level of investment they have and which type of methodology we should use to value those. And then with financial investments, all of those also require presentation and disclosure, especially as you increase your ownership in a company that you're maybe trying to eventually control, like a customer or a vendor, and you want to again control their operations. The more stock that you hold of theirs, the more you're able to do that. So that should all be disclosed in the notes to the financial statements. So then controls over those, if they're really involved in the buying and selling of these stocks and bonds, and they should have formal investment policies in place. Their board of directors should approve these investment activities, and then there should be separation of duties, like who's allowed to authorize the purchase and sale of the securities, who has custody of them, and then who's maintaining those records. So again, it's almost, it's similar to cash in that you should have different people doing those. So again, nobody can steal and cover their tracks. You'd want to have the registration in the name of the company. Obviously, it shouldn't be in like the president's name or somebody like that. If we actually have the physical copies of the stocks, those should be inspected to verify that the company is actually named on the stock itself. And then management reviews the activity in the investment accounts and any related revenue that we've received. And again, any valuation processes, like we said, it goes back to how much of the stock that they have, how it's going to be recorded. So that should be a competent person, because you may have to mark it up to the market value and you want to know that that's being done at the accurate amount. So that is our audit, again, over cash and financial investments.